Hello everyone, here is the answer to exercise 3 of Unit 6 in AC201. In this exercise, our company, Banjo Board Games, is going to be doing some secured borrowing, which means we are going to borrow from a lending institution, in this case Gem Bank, in order to get a better rate of interest, or maybe because our credit history is going to require us to do so, we are going to put up our receivables as collateral in order to get this note. In this instance, on January 1st, Banjo Board Games is going to assign $100,000 of its receivables as collateral. They're going to assign these for an $80,000 note. Why are they not the same? Because there could be bad debt in there. It's not in the bank's interest to have them put up the same exact amount. They're going to have to put up more just in case some of it is bad debt. That way, if for some reason Banjo defaults, the bank should have enough to collect on, they'll take control of the receivables, and they should have enough to collect to make up for their note. We're not selling these receivables though, we're just putting them up as collateral, which would be our worst case scenario, which means Banjo is still going to collect on these receivables because they have ownership of this, and when they collect, they are going to transfer that payment to the bank. Well, the bank is going to charge us a few things. First, up front, they're going to charge us a finance charge for taking out this loan, which is going to be based on a percent of the receivables that we are assigning. Gem Bank's going to assess a 3% finance charge. And then while the loan is outstanding, they are going to charge interest. And the stated rate on this loan that Banjo is taking out from Gem Bank is 6% annually. Banjo is going to make monthly payments for all sums collected, so at the end of each month they're going to figure out what portion of those receivables, which were used as collateral, have been collected, and they're going to remit that payment to Gem Bank. We need to record the entry first for the signing of the note via the secured borrowing on January 1st. Well, we got to figure out some things first. Namely, what's our service charge? The service charge is always based not on the face value of the note, but on the amount of receivables which are being used as collateral. And then we multiply the amount of receivables being put up as collateral, which is $100,000 in this case, by that service charge percentage of 3%. That's $3,000. So Gem Bank is going to discount the amount of cash it's actually giving to Banjo by $3,000. The face value of the note is $80,000, but the lending institution is going to discount it by the service charge of $3,000, which means Banjo is only going to actually receive $77,000 in cash. So on January 1st, we start our journal entry by recording the receipt of cash, debit to cash for $77,000. That service charge is going to go into interest expense. We get to count it on our books as interest, which is tax deductible. That's nice. That's for $3,000. And even though Gem Bank is only giving Banjo $77,000, Banjo is still obligated to repay the face value of the note, and the face value of the note was $80,000. This is our entry to record the secured borrowing from Gem Bank. Whenever you secured borrow, it's always the same thing. The amount of cash you receive gets debited, the service charge amount gets debited to interest expense, and notes payable gets credited and put on your books for its face value. So Banjo still has ownership of these receivables. They're still going to collect on them, and when they do, they're going to remit that payment to the lending institution. During January, Banjo collected $55,000 worth of receivables. So let's start right there. At the end of January, the amount of receivables that were actually collected means we got cash, and the cash is that $55,000. They also accepted sales returns of $5,000. Another reason why the lending institution makes you put up more receivables than the actual face value that you're borrowing. Maybe some people return, stuff, and therefore we have to take the receivable off the books. That was $5,000. We're going to debit that to a contra revenue account called sales returns and allowances. And then lastly, all of those receivables are coming off our books. We collected $55,000 from them. We took $5,000 off the books when our customers returned goods that they had previously purchased on account, which means we had to take $60,000 in receivables off our books when we recorded the collection of receivables for the period of January. On February 1st, Banjo has to remit these collections to Gem Bank. They collected on these receivables that we put up as collateral. That money is owed to Gem Bank, so we're going to send it to them. And again, banks are in this to make money. They're going to charge us monthly interest. So we got to figure out how much interest we owe on this. Let's start there. What is the current principal of the note? It's $80,000. We took it out last month. We haven't made any payments on it yet. The face value is $80,000 at the time that we signed the note, so it's still going to be $80,000 now. We need to multiply that by the monthly interest rate. And to find the monthly interest rate, you take the APR, the annual percentage rate, and divide it by 12. This is a note with a 6% APR. We want to convert that from the yearly annual rate down to the monthly rate, so we divide it by 12. That is 0.5%. So we take the outstanding amount of principal, $80,000. We multiply it by the monthly interest rate of 0.5%. That's $400. So not only are we going to have to remit the portion of receivables that we collected, but we're going to have to send an extra $400 to GemBank for the interest that is accrued on our note. So on February 1st, we debit notes payable for the portion that is going towards principal. Well, how much is that? It's whatever portion of receivables we collected, right? These receivables are collateral. We told GemBank that whenever we collect on them, we're going to send the money over, which means we're going to reduce our principal by the $55,000 worth of receivables that we collected during the month of January. We're also going to send them an extra $400 for interest that is accumulated on our note, which means in total we are sending out $55,400 in cash. Debit to notes payable for the principal portion, debit to interest expense for the interest portion, and cash for the total, credit to cash for the total amount of payment, which in this case is $55,400, when we remitted January's receivable collections to GemBank. During the month of February, Banjo Board Games collected another $63,000 worth of receivables, and they wrote off $3,000 worth of bad debt. We need to record Banjo's entry for February changes to AR. Well, what happened? We collected $63,000 worth of receivables. Let's debit cash for $63,000. We also wrote off $3,000 worth of bad debt. And Banjo Board Games, like any company that is, has to adhere to GAAP policy, has to use an allowance for bad debt. So that $3,000 of bad debt is going to come out of our allowance. We're going to debit allowance for bad debt for $3,000, and we are going to credit all of our receivables for $66,000. We collected receivables for the month of February. Now we're going to make our payment to GemBank for February's collections. We're going to do so on March 1st. How much money are we going to be sending out to them? Well, first things first. When we took out the note was for $80,000. In an RT account, we would have put $80,000 into our notes payable T. On the 1st of February, we had our first payment. We remitted our first payment to GemBank, and when we did so, we paid $55,000 towards principal, and we debited it. So what is the outstanding balance of this particular note? Well, it's $25,000. That's how much we owe them. So it doesn't matter that we collected $63,000 worth of receivables last month, because we don't owe them $63,000. We're not going to give them all of our receivables. We're only going to give them as much as we owe them, which means we're not going to calculate interest based upon what the receivables were we collected. Interest is based on the current principal balance of our note. So we're going to take the $25,000, multiply it by our monthly interest rate, which we already determined is 0.5%, come up with $125. And in the entry, we're going to record an interest expense of $125 for the interest that is accumulated on our note. And we're going to debit notes payable, again, not for the amount of receivables we collected, but whatever the outstanding balance was. If you owe less than the amount of receivables you collected in the period, you're not obligated to send over that extra money. So with just the $25,000, we're going to credit cash for $25,125 when we remitted February receivable collections to GemBank. And that's the end of the note that we took out with secured borrowing. We're paid off now. We got our money up front. We paid back what we owed, back to square one. Maybe we'll do it again in the future, but for right now, Banjo Board Games is out of debt to GemBank. Let's do another example here. On this one, same setup, just with different numbers. Wilson Wire is going to assign $120,000 of receivable as collateral for a $100,000 note from Berkshire Bank. And under the terms of this arrangement, Wilson still has to collect on the accounts receivable because they still have ownership of them. Berkshire is going to assess a 2% finance charge on the receivables used as collateral, And they're also going to charge Wilson Wire Mills 7.5% annual interest rate on this note while it is outstanding. And Wilson's going to transfer payments at the end of each month. So let's first start by putting this on the books. We're going to find our service charge, which again is based on the amount of receivables used as collateral, not the face value, so $120,000, and the percentage that Berkshire is charging Wilson is 2%, so that's $2,400 service charge. So while the note has a face value of $100,000, it's being discounted by the $2,400 service charge, which means Wilson is only going to receive $97,600 in cash at the time of the note's signing. So we debit cash for $97,600. We debit interest expense for the amount of the service charge, $2,400, and we credit notes payable for the face value of the note, which is $100,000. During January, Wilson's going to record all of the collections and other items related to these receivables. They collected $80,000 worth of receivables, so we can debit cash for the amount of actual collection, which is $80,000. They also accepted sales returns of $5,000, so we're once again going to debit that sales returns and allowances contra revenue account for the amount of returns and allowances that we accepted, which was $5,000. And in total, $85,000 worth of receivables must be coming off of Wilson's books for the collections that they made during January. Now they got to transfer some payment. So again, this is their first payment. The face value of the note was $100,000. They still owe the whole $100,000. The note has a 7.5% APR, but we need to convert that to monthly. So we take that 7.5% and divide it by 12, and we come up with 0.625%, or 5/8%. If we multiply $100,000 by 0.625%, we get $625. So for our first payment, we are going to transfer an amount that goes towards principal equal to the cash collections we had from the receivables we used as collateral. That's $80,000. And we are going to debit interest expense for the amount of interest accumulated, which was $625. So we need to send Berkshire Bank $80,625. Credit cash for that amount when we remitted January receivable collections to Berkshire Bank. And then again, during February, Wilson collected $30,000 worth of accounts receivable and wrote off $3,000 worth of receivables as uncollectible. What are we going to do here? Well, we're going to debit cash for the amount of actual collections, which is $30,000. We are going to write off those receivables by using our allowance. So we debit allowance for bad debt for $3,000. And we're going to take $33,000 worth of receivables in total off of our books because they're either no longer owed or they're considered to be bad debt. They don't need to be on there anymore. And we recorded our collection of receivables during the period. Now we got to send some payment over to Berkshire Bank one more time. Again, when we put the note on the books, we put it on for $100,000. In our first payment, when we paid towards this loan that we had, which we took out via secured borrowing, we put up receivables as collateral, we paid off $80,000 in principal, which means at this point, Wilson owes Berkshire $20,000. So when we calculate our interest rate, we are going to calculate it based upon that $20,000 in principal still on our note. The monthly interest rate was 0.625%. So if we multiply 20,000 times 0.625%, we come up with $125. Then on March 1st, we're going to debit interest expense for the amount of interest we have, which is $125,000. We're going to debit notes payable for the amount of principal we still have to pay off. We collected more receivables than we owed on this note, so that's going to be the remaining balance of the note, $20,000. And in total, we're sending $20,125 of cash over to Berkshire.